Hey, friend, welcome back to the Live Off Rent show, where we bring in real estate and other financial experts to help you build passive income, create your dream lifestyle, and reach financial independence. As always, I am your host, Brian Davis, co-founder of Spark Rental. I'm on this journey with you in the trenches every month, investing together in deals in our co-investing club. And without further ado, I am really pumped to introduce our guest today. David McElwain is a seasoned real estate investor with experience in multifamily, commercial retail development, asset management, single family, vacation rental properties, second homes, and custom builds. He founded Mac Assets in 2019, and he is a general partner in over 1,000 doors. So, David, welcome to the show.
Thanks for having me. I'm excited to be here, Brian. And for
Absolutely.
the record, it's no longer 1,000 doors. We sold 400, so now it's only 600.
Okay. Well, what's in a number anyway, right?
It's just a rounding error, right?
Well, I usually ask guests when they come on the show just to start at the beginning with how you got into real estate investing in the first place.
Yeah, it's a tried and true path. I was in corporate America making big, sick money, and I needed to put some capital somewhere. So that's how I got into commercial development. I bought into some syndications back before syndications were in vogue. And it was more of a who do you know than anything else. There was no opportunity. This is, pre-Jobs Act of 2012. And from there, I bought into second homes and third homes and made those into vacation rentals. And this is before Airbnb existed. VRBO was just coming into vogue. Fast forward several years, I can tell you the biggest regret was not buying rentals at that time because I didn't want to be a landlord.
It was a great time to buy, right?
My
The
first wife did not want to
post-Great
be a
Recession.
landlord. And this is early 2000s.
Ah,
And fast forward 15 years, mid 2012, I lose my corporate job. I go through a nasty divorce. I lived on an airplane traveling 3-4 days a week, and I couldn't do that as a single dad. Tried startup world. That deal fell apart. By 2014, I am unemployed, single dad of two, freshly divorced, trying to replace a mid 6-7 figure income, and turned to real estate. Got my real estate license, was going to flip houses, realized the flipping market in Denver where I live was not what I wanted it to be, and the returns weren't sufficient. So I became basically a broker. From there, I started buying my own portfolio. And eventually I was in a meeting in an investment real estate club, and I heard somebody talking about syndications on multifamily. And in my previous job, I had sold at scale. So I would sell 1 city or 5 cities or 50 cities. I knew very well that doing 1 city was the same work as doing 50 cities with the same client. But there were 3 more zeros on a check.
right.
And so when apartments hit me in the face, I changed my entire business plan in a day. And I jumped all in on multifamily.
Yeah,
And from there, it kind of grew.
that's a story of scaling that I've heard again and again from investors who made that leap from single family homes to multifamily, and in particular, the larger multifamily doing syndications, that it's not an order of magnitude in more work, but it is an order of magnitude in more money. So it's scalable.
And let's talk about lessons learned here, because people think that the jump from single family duplexes, quadplexes to 100+ unit doors is a no-brainer. And I made a lot of mistakes, and I wish I had gone from 2 to 10 to 50 to 75 to 100. And I think that's something that in the go-go 2020s, people forgot. And I'm the first person to admit that there was a lot of painful learning on that.
Yeah, that's it's a recurring theme that I come back to again and again when I share my own real estate investing story, is how many preventable mistakes I made when I first got into real estate investing. If I had only gotten a mentor, a coach, a senior partner, somebody who had made those mistakes before and could help me walk around those big pitfalls in the middle of the road.
Mm-hmm.
So I certainly sympathize with
Yeah, the mistakes are you can read the books and you understand the learning, but until you actually do the transactions and until you're in the day to day where the book doesn't cover it, you don't know what you do not know.
Right.
And I've run businesses, I've run organizations, I've run teams. I know an awful lot about doing things at scale. I had global sales organizations in one of my assignments, but dealing with contractors 800 or 1,000 miles away is very different than dealing with professional white collar employees 800 and 1,000 miles away.
No question.
Yeah.
And, to your point, until you're in the trenches doing it, people can tell you things like, oh, you need to be really aggressive with your due diligence, and so you'll say, okay, yeah, sure, if you haven't actually been burned before, so you might go through a checklist, but you're not going to be really digging into the details if you have not been burned before, right?
Well,
Yeah, and that's something that working with a mentor can sometimes impress upon you. But no matter how many books you read, you can't necessarily get that visceral sense of, oh, this is something I really need to actually like dig into.
yeah. And here's a great illustration of that. How many people that are listening to this show have bought a house before 2008?
Well, I
Probably a
certainly did.
third.
Actually, well, yes, I did, but it wasn't a personal residence.
Okay. But if you think about it, most folks that are in the age of 30 to 50, 25 to 45 is a safer number. The interest rates that they paid for their mortgages was never greater than where it is today.
Right.
My first house, my interest rate payment was a 9% interest payment in 1996. And so for people that have never felt what a 7% interest rate payment feels like, you can read the book and you can understand, oh, okay, so instead of being $300 in interest, it's $800 in interest,
Right.
but you don't understand it viscerally.
Right.
And those are the kinds of things that you have to get in the trenches to experiences. Like if you're going to buy a house right now and it's 7% or 8% for the mortgage, you're viscerally understanding the difference in the Fed interest rates. And you're definitely understanding the difference in the spread of SOFR and what those things mean. And that's a big part of this learning. And, if you've got a house that you owned in 2008, where you went upside down and you lost it because you didn't have enough equity in the house to protect it, you know what that means. But if you didn't, you're like, oh, I'm not going to be that guy. And then you become that guy.
Right. Yeah, you don't take the risk as seriously. I mean, sure, anyone can learn how to calculate cash flow on something based on different interest rates, but if you don't think that the risk of high interest rates is real, then you're not going to go through the exercise of doing so, right? Like
Yeah.
you're just not going to take those risks as seriously.
It's almost a cynicism test. Look
Yeah.
at it. In 2020, insurance rates were going up at 5% a year. 2021, they went up, COVID hit, they got a little more expensive. And then in 22, they skyrocketed. And if you haven't lived through
Oh, more
that,
than doubled. Yeah.
yeah, if you haven't lived through that, what do you think about insurance when you're underwriting? You think the cost of inflation is 3%, inflation will never happen. It's never experienced in my life. I remember the 80s and I remember the 90s. And, so like for me, this inflation stuff, okay, I know that the pricing on some things will never, ever drop again because the consumer's been trained that they will pay X for product Y and the sellers will never drop their price. Some commodities will change, right? But when you really look at it, these kind of experiential learnings, these cellular DNA learnings, sometimes the books aren't sufficient for it. And I think that's what I mean by it, right?
Yeah, no, that makes total sense. And in our investment club, it's one of the things that we really like to see when we're looking at sponsors and vetting, GPs, syndicators on deals, is have they been through a couple housing market cycles? Were they investing in real estate in the 2008 crash, right? We like to see that because then we know that they understand viscerally just how bad things can get, and they are going to take that downside risk more seriously, right? So it's something, it's not a hard and fast rule when we're looking at sponsors, but it is something that we take into account. Have they been through, more than just a hot market cycle?
Right. And the investor risk tolerance is crucial to understand as a sponsor, and it's crucial to understand as an investor. If you don't understand what your risk tolerance is, you don't know what you're doing.
Well,
And I remember like in 2008, I and my first wife and I had lost six figures in our portfolio on paper. And she came to me and said, I can't stomach this anymore. And I said, okay. And we sold everything in our portfolio.
oh,
We took a realized six-figure loss, and the next day started the bull market.
spring of
And what,
2009. Yeah.
yeah, so what do you learn from
Yeah.
this, right? You learn where the risk tolerance is. And in that illustration, my partner's tolerance was different than mine. Am I blaming her? Not at all. Did we both intellectually understand that the market would come back? We did, but we thought it was going to get more ugly than it did. And this is part of that. You can't teach this in a textbook. And that risk tolerance, I think, is so crucial, right?
Well, so on that note, I'm curious to hear, as a syndicator yourself, how do you go about minimizing risk in your investments? And as a corollary to that, what are some of the risks that you see in the market right now that maybe not enough other real estate investors are talking about?
Okay, so two questions there, right? And I'm going to give you a very different answer to the risk
Yeah,
no one's
please.
talking
Yeah,
about.
no, they're definitely two
So
different
let's go
questions. So
first with minimizing risk.
yeah,
I haven't brought a deal to market in a while because I haven't found the deal I like.
okay.
For me, I've gotten ultra conservative because I am seeing that some things are playing better. Right now, with the T-bills making 5%, you're really banking on cap rates compressing to make an accretive return on the value add position. And I'm not sure they're going to. I think we're going to have more cap rate expansion for a while. I am bullish on class B and C suburban small office. I'm in one of those right now, and it's full because guys like me that have small businesses don't want to work in our basement. We don't want to work in our home office. We need to get out. And
I'm the same way.
yeah, I'm going to pay for an office. And so I'm bullish on those for that reason. Also, I'm bullish on medical. You know, the doctor's not going anywhere.
Certainly not with baby boomers
No,
aging into their senior
no,
years. I mean,
no. So then protecting risk is going to be about really conservative, defensible underwriting. And defensible, I don't mean that it makes logical sense. It's does it fit the investor's risk tolerance system? If your risk, I had an investor interview yesterday with a guy, and he's like, I want something in the 13 IRR range. Okay, that's rational. But he's looking at sponsors that are promising 18. He's redoing their underwriting, and he's saying if it'll pass his muster at 13, he's okay with it. And I think that's the thing is I want my underwriting as a sponsor to come out and say, yeah, I agree. Or this is close enough to where I would make no different assumptions. And part of that is a reduction of is an increase in fixed debt and a reduction in expectation of performance. So going to the second part of the question. Oh, I'm sorry.
no. Please go ahead.
The second part was risk. And I kind of want to talk about the NAR settlement for a little bit from a risk perspective. And if you don't realize this is the National Association of Realtors. I actually own a residential brokerage as well. And
Okay.
the NAR settlements is changing the way real estate is going to do business effective this summer. Basically, what it's saying is that sellers no longer are going to be required to compensate buyers' brokers for the transaction. And as an investor, what does that mean to investors? And it also says that all real estate commissions are now negotiable at all fronts. Newsflash, they always were.
Right.
The press around this is such that it's very one-sided that agents are, slimy used car salesmen selling lemons, which is also not the case. But as an investor, we now have risks that we didn't have before. If we're going to be using agents in the marketplace to buy single family or small multifamily or any other product, we have to factor in that compensation element or go without experience and expertise. And I think there's a lot of unknowns coming forth in the summer of 24 as to how the marketplace shakes out.
Based on how agents are compensated?
Yeah, because think about it. If you're a small time investor and you're buying your first property And you would typically have an agent who's an investor agent, and you'd say, "Hey, I want you to represent me," and the seller is going to pay that investor agent their 10, 15,000, 5,000, 8,000 bucks. You don't factor that into your cost.
Sure.
So now you have to. Or if you're a shoestring investor, what are you going to do? You're going to go on your own. You're going to decide that you don't need their expertise. And
Right. So you may end up
that's
overpaying or
you're overpaying, or
overlooking red flags,
you're
in the
missing a red
building.
flag.
Yeah.
You overestimate the rental marketplace. There's an awful lot of things that as a first-time investor, agents help people save their skin from. And so I
No
think there's
question.
a risk here to mom and pop on Main Street that are the small entry-level investors, that they need to be cognizant that they've got to think this whole process through.
So a risk in maybe overpaying for properties on the one hand, and then on the other hand, having to come out of pocket to pay if they don't go it alone, coming out of pocket
Yeah,
to pay a
those are
realtor.
just two. Those are two economic risks, but I could
Yeah.
see this in a system of categories of economic, ignorance, property condition, and arrogance. So, if you're a brand new guy and you read the book and you read, oh, I read Flipper book 1. I
Right.
know how to flip a book. I know how to flip this. I don't need anybody to do it. And I'm not going to pay somebody to sell it on the other side. Then you could have all kinds of different risk points, whether it's inspection objections or whether it's plumbing or whether it's construction or whether it's permitting, all those things that agents do that people don't think they do. They don't recognize they do. And I think it's also important because it's going to change the marketplace. Commercial real estate transacts much slower than residential. There is no true MLS in commercial. In Europe, and I think in Central America and South America, there often are not buyers agents represented, and the transaction time to sell a house is much longer than it is in the States. And I think these are all factors because time of transaction is definitely a part of the element of the time value of money. And
Sure.
I don't know that there's one risk to identify as much as it is, hey, Mr. and Mrs. Main Street investor, beware, this is a massive change. We don't know how it's going to play out, but you've got to process this in your underwriting. If you have a cost of sales of 1%, you're probably wrong if you're going to dispose of an asset. But if you have a cost of sales of 6% and you're only going to pay 3% now, you've just had a 3% growth. So all these factor into that underwriting. And that's where I think about it from a risk that people aren't talking about. And yes, a lot of folks focus on the commercial side where the commercial broker is not paid by the buyer. And usually the broker is really a double-ended broker representing both the seller and the buyer. And so that brings on a whole nother set of risks. But the reality is that in the commercial world, they expect everybody to be a professional in doing this for a living. And so the risk of ignorance disappears. But in the four unit and below, they don't expect everybody to be a professional. And like I said earlier, people start with 1, then 2, then a 4, then a 10. And the 10 guys are not doing the same quality of professional skill set that the 500 unit guy is doing.
Right.
Right. So I don't know that it's a clean answer to your question, but I think it's one that's needs to be talked about more.
Well, no, it's a good answer in that these sweeping changes to how residential homes are sold, they add uncertainty to the residential real estate market. And it's unclear exactly how all that will shake out. But uncertainty creates risk, right? And so to your point, that's a risk that probably not enough residential investors are talking about. So no, I appreciate that answer. And that's not, I like to ask guests that question. And I love the breadth of answers that we get. And that your answer is actually one that I have not heard before on this show. So I appreciate that.
Yeah. And if you think about it, it's more than just residential. Because out of the residential marketplace are all the single family rental properties that really kind of fall in this commercial residential hybrid scale because they are investment properties and they are being viewed that way. So that's why I like to think about it in terms of what is the macro risk. And, this is a systemic change rather.
So David, I want to pivot a little bit here. I
Mhm.
know you love to talk about breaking the golden handcuff. So can you tell us a little bit about how you did that yourself, and what tips you would give to someone else who, is looking for ways to break their own golden handcuff to their day job, their full-time salary.
Yeah. So I love that. And I have a podcast, obviously, with the same name, Break Your Golden Handcuffs. And
It's a great name
the
for a
reason I
show, by
brought
the way.
this out is that, and you're going to guest on that shortly. The reason I brought that out is that I had golden handcuffs in the 90s and 2000s before I lost my job and my divorce. And I lost a job through a merger. And over the 7 division of CBS and Viacom, I made sick money and I didn't know what to do with it. And I kept wanting to quit, but I had too much money to quit. I couldn't walk away from the money I was making. And so I built a plan. And what I heard somebody say, a W-2 pays you just enough to take away your soul. My wife read that to me yesterday
That's
from a social media
that's
post.
such a cynical way of looking at it, but I certainly understand the point behind it.
Yeah, and I don't know who the author was. And I was like, well, that's a little bit aggressive, but I was miserable. And I didn't know how miserable I was until I got out of it. And what I like to do is teach people how they can take their current benefits, whether it's too much income or whether it's not enough time in the day or whatever their negative thought is of their job, and turn it into basically gold bracelets. So what I did is I built a system that would allow my kids to go to college for free. I paid off all of my debt. I built a plan of what I would do. I started to do things, and this is before side hustles were really prevalent. I started to do small businesses, small investments. I started to look at macros of where I wanted to go with my career. And when my job was taken away from me, and I will say this, it's not if you're going to lose your job in corporate America, it's how and when.
Right.
I've gone through 3 layoffs. All of them were not performance related. They were all riffs or mergers. And it had nothing to do with David or his performance. But yet I'm the one that suffers from it. So I encourage people to have a holistic point of view. And breaking your golden handcuffs means things like looking at your diversification. If your income, your retirement, and your stock options are all in the same employer, there's no diversification.
Right.
If your income is in, let's say, farming, and your investments are in precious metals, and your retirement is in consumer durables, that's a whole lot different diversification. And I try to teach people that there's more than one way to look at this vision. And creating passive income is beneficial, but creating a life plan is more valuable than creating the magic passive income stream. I got to have 10 passive income streams. Well, that really means you've got probably 8 that are mediocre at best and 2 that are decent. So it's about sovereignty and agency of your life.
Well, I love that. And you passed over something very quickly that I think listeners might want to hear a little bit more about, and that's covering your kids' college expenses for free. So I'd love to hear a little bit more about that.
So when my first daughter was born in 2003, I had a big commission check, and 529 plans had just been brought out. And I literally put in a 5-year maximum donation in year one, in month 1. She's gonna be she's a rising senior as of next month. And I haven't touched her college account. I haven't paid a penny out of my own pocket. The next year, my son was born. Same scenario. He's a sophomore right now, and I haven't paid a penny out of his pocket either. And it was a magic thing because I got a W-2 tax deduction, and I didn't pay tax on that money, and it grew tax-free, and I left it alone, and it's paid every penny. And depending on how the next couple of years turn out, they might be able to go to grad school for free.
That's awesome. And, classic example of compounding returns, right? And the magic of compounding returns.
It's like you don't believe the guy telling you that if you do this, this will happen. But I'm living proof that it did happen. And, when you're doing this, the other way to do this is to just go buy a rental. The one rental, the day the month your kid is born, buy one rental, put it on a 15-year note.
Yeah, it's
Same
something.
song, second verse.
Yeah, yeah, and you don't even need to sell the property. when it hits 15 years and it's paid off, you could refinance it and pull out most of the equity that way and keep the property, keeps appreciating, keep running cash flow on it. But you've pulled out enough money to cover your kid's college education. So
yeah, and it's a debt service question for you, right? And like
yeah,
you could literally sell it, put it into a T-bill at 5% right now, and be pretty happy without any risk.
there you go.
So it's really about understanding risk. That's how you break your golden handcuffs.
I love it. So David, if people are interested in investing with you, how can they learn more about you? How can they learn more about breaking the golden handcuff, potentially investing with you? How do people connect with you?
Two ways. One, tune into my podcast, Break Your Golden Handcuffs. It's on every major podcast platform. And my website is macassets.com.
I love it. Well, David, thank you so much for joining us today. We hope to have you back soon.
Likewise, it's a pleasure.
Guys, if you enjoy these conversations that we have, please rate, review the show. It means the world to us. And we will catch you same place, same time next week. Bye now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have average returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.